What if I told you the next Federal Reserve chair could completely change how markets crash and how they recover? And what if the media is missing the biggest part of this story? President Trump is expected to nominate Kevin Warsh to replace Jerome Powell as chair of the Federal Reserve in May. But this is not just a political headline. This could change how money gets printed, how crises are handled, and how your investments, stocks, crypto, gold, and silver, behave in the next decade. And here's the part nobody is explaining clearly. Warsh is not trying to stop money printing. He wants to change when it happens. And that difference could mean bigger crashes, bigger rallies, and way more volatility. If you're an investor, you need to understand this shift. Today, I'm going to break it down in the simplest way possible. Part 1. Who is Kevin Warsh? Let's start with context. Kevin Warsh is not some outsider criticizing the Fed from a distance. He was inside the system. He served as a Federal Reserve governor from 2006 to 2011. That means he was there during the 2008 financial crisis, one of the most dangerous economic moments in modern history. He worked on bank rescue programs, emergency liquidity support, and the early stages of quantitative easing, also known as money printing. So he understands crisis policy firsthand. But after leaving the Fed, he became one of its biggest critics, especially when it comes to constant money printing. And that's where things get interesting. Part 2. Powell's strategy right now. Under Jerome Powell, the Federal Reserve follows a clear philosophy: prevent the crisis before it happens. How? By keeping liquidity flowing into the system. If financial markets show stress, the Fed adds money. If credit markets tighten, the Fed adds money. The goal is simple: no panic, no emergency, no meltdown. But there's a cost. Constant money printing creates persistent inflation, asset bubbles, and a weaker dollar over time. It's like putting the economy on a steady drip of stimulus. No big crashes, but also no real reset. Part 3. Warsh's very different view. Now here's where Warsh breaks from Powell. Warsh believes central banks were designed for one main purpose: to fight emergencies, not to prevent them every day. His philosophy is this: stop constantly money printing. Let markets function normally. If stress builds, if bubbles burst, if panic hits, then the Fed steps in with overwhelming force. Not small, steady support, but massive emergency intervention. In his own words, central banks should respond to panic with overwhelming force. That means less support during calm times, but huge support during crisis. Part 4. The key difference, very important. Here's the part most people miss. Both Powell and Warsh lead to money printing. The difference is timing. Powell is steady printing. Warsh is crisis printing. Let me explain it simply. Imagine your salary. Would you rather get paid small amounts every week or get paid a giant amount once every few months? Same total money, different timing. Powell's system is smooth income. Warsh's system is long wait, then big payout. For markets, that means Powell, fewer shocks. Warsh, more booms and busts. Part 5. What this means for markets. Short term, expect more volatility. If markets believe the Fed will not step in quickly, fear increases, uncertainty rises, and markets hate uncertainty. That means bigger swings in stocks, sharper drops, faster emotional reactions. Medium term, we could see rotation. Less constant liquidity hurts speculative assets. That means high-growth tech, risky startups, crypto, and Bitcoin. These may struggle more during tightening periods. Meanwhile, companies with profits, cash flow, and strong balance sheets may outperform. Part 6. What about Bitcoin and crypto? Bitcoin behaves like a high-powered tech stock. It loves liquidity. It hates tightening. Under Warsh's approach, liquidity would be less predictable. That could mean bigger crashes in crypto, followed by explosive rebounds during crisis stimulus, so not necessarily worse long-term, but much more volatile. Part 7. Gold and silver. Precious metals investors shouldn't panic long-term. Why? Because Warsh isn't fixing the root issue, confidence in the dollar. Inflation doesn't disappear. Money printing still happens. The dollar still gradually weakens. The only change is timing. Part 8. The big question. So what's actually different? Not the outcome, just the path. Powell prints steadily. Warsh prints in emergencies. In the end, the total money creation could be similar, which means inflation pressure continues, dollar devaluation continues, debt keeps rising. Part 9. A reality check. There's also another possibility. Warsh talks tough now, but once in power, he could do exactly what Powell does, because politics matter. Would any president really want a Fed chair who restricts markets before elections? History says probably not. Final thought. So here's the truth. This is not about stopping money printing. It's about changing the rhythm from smooth to shock-based. And that means the future may look like more fear, more volatility, more dramatic market cycles. For investors, that means preparation matters more than prediction. If this helped you understand what's really going on behind the headlines, subscribe, because the next few years in financial markets are going to be anything but normal. And the people who understand the system will be the ones who survive it.